Time for our ETF Spotlight. Mike Santoli looking at M&A on the heels of all these terminated deals, Mike.
Yeah, Carl. So these are trading in deal stocks themselves. So essentially, after a merger and acquisition is announced, the very old strategy is to play arbitrage and essentially own the stocks that are being acquired and perhaps short the ones that are doing the acquiring. You just capture the spread. This is not meant to be a directional strategy, not meant to speculate on the next potential deal. But you see this chart here. There's one good-sized ETF that's committed to this strategy, the IQ Merger Arbitrage Fund, symbol MNA. It's not performed as well as the market. It's not really designed to. The way this one works is after a deal is announced, there's an index into which they put the targeted stock. They don't short the acquirer stock, though. They short either a sector ETF or the market against it, so it's lower volatility. I have to say, as ETF structure, it's probably not ideal because you can't use leverage. I mean, the hedge funds and prop desks that used to do this very actively, you take leverage and you amplify small returns. But this fund did own, at last report, Rite Aid and Express Scripts. So you see what happens if you have a deal that breaks. Typically, they're going to suffer a little bit. This fund down a little bit today in a flat market.
Expectations, I mean, they must build in the possibility that some of these deals are not going to close.
Well, they build in the sense that they try to hedge it a little bit. They don't necessarily buy every single deal, but the people who do this as an active strategy are going to be very discerning about it, right? They're going to be reading legal documents. They're going to try to assess, in the case, for example, of AT&T Time Warner, does the government have a case? Can they scuttle this deal or not? So I think that in this case, when you're you're fitting it into an index and an ETF, it's not ideal.
They're just taking the spread wherever it may be.
Right.
And that's...
And typically, David, they would market these strategies as almost a bond substitute, right? They're not saying we're going to shoot the lights out. They're saying it's not correlated to the overall markets or inflation or interest rates, but we can give you some kind of a steady return that comes from the fact that the market leaves a spread on the table there, typically in a deal.
Really good topic, especially on a day like today. Thanks, Mike.
See you guys.
Mike Santoli.